Welcome back to the Daily Crypto Roundup. The markets have been hit hard again, and there's no sugarcoating it. This is one of the biggest single-day corrections we've seen in weeks. Prices across the board are red, traders are nervous, and the question everyone's asking is, what's caused this drop, and is the worst finally over? We're going to unpack all of that today. If you find this show useful, take a second to follow and leave a 5-star rating on Spotify. It really helps more people find these updates and keeps this show growing. Now, let's look at the numbers, because that's where the story begins. Bitcoin leads the pack, trading around $117,690, down roughly 2.5% in the last 24 hours after another round of long liquidations swept through the exchanges. Ethereum sits near $4,099, down just over 5%, with ETF flows showing early signs of cooling. BNB holds around $1,227, slipping a little over 1% but still outperforming most altcoins. Solana is priced around $209, lower by just over 4%, while XRP trades at $2.87, down close to 4%, but still showing heavy on-chain activity and institutional accumulation. Dogecoin trades near 23.5 cents, down about 4%, while Cardano sits just above 81 cents, edging 0.5% lower. Tron changes hands around 33 cents, down about 1.5%. Chainlink is holding up better than most, trading at $22.38, up nearly 2% on the day, while Avalanche rounds out the top 10 at $26.78, down about 4%. Every major coin is either red or barely hanging on, and that's the message of the day. This isn't a small correction. It's a reset after an overheated rally.
So, what exactly triggered it?
First, we've seen a brutal wave of liquidations. Hundreds of millions of dollars in leveraged long positions were wiped out in hours. When leveraged traders all get caught on the same side, a small dip can cascade into an avalanche. As prices fall, stop losses hit. Positions close automatically, and that creates even more selling pressure. This is what traders call a liquidation cascade, and it's exactly what's been unfolding. Second, the dollar is flexing its muscles again. The US dollar index has been climbing for the last 48 hours as yields stay firm and investors rotate into safer assets. When the dollar strengthens, it hits everything else that's risk-on. Stocks, commodities, and yes, crypto. Add in higher treasury yields, and suddenly people are less willing to hold volatile assets. Third, ETF flows have cooled off. After weeks of inflows, the latest data shows that the record-breaking demand from institutions is pausing. We're seeing slower buying into Bitcoin ETFs, and in some cases, even small outflows. It doesn't take much. When that institutional bid softens, the floor underneath the price disappears. Fourth, this is classic profit-taking. Bitcoin touched new all-time highs earlier this month. Ethereum pushed above $4,500. Traders who have been holding since the summer are taking money off the table. There's nothing sinister about it. It's just how markets breathe. They expand, and then they exhale. And fifth, there's technical exhaustion. Analysts had been warning that on-chain metrics were flashing hot. Funding rates were positive across every major exchange, meaning too many traders were betting on the same direction. When that happens, you only need one sharp move down to flip sentiment completely. All of these factors, liquidations, a strong dollar, cooled ETF flows, profit-taking, and overheated leverage, collided at once. And when that happens, even the best projects take a hit. Now, let's shift to the news shaping today's sentiment, because there's more happening beneath the surface than just price action. The first big story is regulatory, and it's causing ripples in Washington. Bipartisan negotiations over a new US crypto bill have completely broken down. Democrats and Republicans can't agree on how to handle decentralized finance and wallet oversight, and the latest leaked draft extending KYC requirements to validators and node operators has caused chaos in the industry. Coinbase CEO Brian Armstrong went public, calling it a bad law written by people who don't understand the technology. It's another reminder that while the US is trying to catch up on regulation, it's still tripping over its own politics. The bill could have been a huge step toward clarity, but for now, it's back to gridlock. The second story is institutional. Intercontinental Exchange, the parent company of the New York Stock Exchange, just made headlines by investing $2 billion into Polymarket. The move values the prediction market platform at nearly $9 billion and instantly turned its founder, Shane Copland, into one of the youngest self-made billionaires in the world. It's a signal of where institutional capital is flowing, into projects that merge crypto infrastructure with real-world financial applications. Polymarket's transparency, powered by blockchain, is proving that crypto-native technology can thrive even within regulated finance. The third story is where things start to get really interesting. 10 of the world's largest banks, including Bank of America, Deutsche Bank, Goldman Sachs, UBS, Citi, and Barclays, have revealed that they're exploring issuing stablecoins pegged one-to-one with G7 currencies. If this goes ahead, it would be the biggest bridge between traditional finance and blockchain we've ever seen. Imagine opening a Barclays app and holding a tokenized pound that settles instantly anywhere in the world. That's what's on the table here. It's still early, but the implications are enormous. It also puts pressure on central banks. If private banks start issuing their own stablecoins, it accelerates the move toward a programmable financial system, one that might make CBDCs feel redundant before they even arrive. The fourth story brings us to mining, but not the kind you're used to hearing about. Bitcoin miners are being re-evaluated as potential players in the AI revolution. A new report from Bernstein explains that Bitcoin mining companies already control some of the largest grid-connected energy capacity in the world. That gives them an edge in powering AI data centers, which need vast amounts of cheap, reliable electricity. Companies like Iron, Bitfarms, and CleanSpark are being courted by tech firms looking for partnerships. If mining companies can rebrand themselves as digital infrastructure providers, not just crypto miners, it could reshape how investors value them. Before we move on, a quick reminder to protect what you hold. If you haven't already, check out the Ledger hardware wallet. Keeping your coins in cold storage is still the best way to stay safe, especially in volatile markets. You can find the link in the description. Now, the fifth major storyline today is about concentration, and it's both impressive and worrying. BlackRock's Bitcoin ETF has officially become one of the largest single holders of Bitcoin in history, approaching $100 billion in assets under management. That dominance is a double-edged sword. On one hand, it shows institutional confidence. When giants like BlackRock, Fidelity, and VanEck allocate capital, it legitimizes the asset class. But on the other, it creates a single point of vulnerability. If one fund's flows turn negative, or if regulators shift their stance, it can ripple through the entire market in hours. And all of that brings us back to the here and now. This crash, this moment, and what it really means. The truth is, nothing fundamentally changed overnight. Bitcoin's supply didn't increase, Ethereum's network didn't break, Solana's activity is still soaring, XRP's legal clarity still stands. What changed is sentiment, and sentiment in crypto can turn on a dime. After weeks of euphoria, a single round of liquidations exposed just how leveraged and overconfident some traders had become. It's painful, but it's also healthy. Every market needs to reset before the next leg up. Remember what happened in 2020 and 2021. Bitcoin dropped 30% in a single week, only to rally more than 300% in the following months. The same pattern has repeated again and again across every cycle. It doesn't mean history will copy itself exactly, but it does remind us that volatility is the admission price for long-term returns. So what should investors do right now? First, breathe. Second, zoom out. If you're holding assets you believe in, short-term red candles don't erase the long-term trend. If you're over-leveraged, take it as a lesson and manage your risk better next time. If you're sidelined and waiting for entry points, this kind of correction is what long-term opportunity looks like. Not financial advice, but every veteran in crypto knows that fear creates the best entries. As for the week ahead, keep an eye on ETF flows. If inflows resume, momentum can return quickly. Watch the dollar index. If the greenback softens, crypto breathes again. And listen for macro catalysts: CPI, Fed commentary, and global rate talk. These are the strings that move everything else. The biggest thing, though, is confidence. This market runs on belief. Belief in math, belief in code, belief in a system that can't be printed or manipulated by decree. That belief has survived every crash, every hack, every lawsuit, every headline. And if you're here today, listening after a week like this, you're part of the group that gets it. You understand that cycles don't end with red, they reset with red. So stay sharp, stay safe, and keep perspective. Markets don't reward panic, they reward patience. Follow the show, leave that 5-star rating, and share this with someone who needs a dose of perspective right now. Because in crypto, storms pass fast. And when they do, they leave behind cleaner charts and stronger hands. We'll be back tomorrow with the next update, new stories, and hopefully some green on the board. Until then, hold strong, stay smart, and we'll see you at the top.